Hey guys, Jim Thornton here, Real Mortgage Associates, Ontario, Canada. Just wanted to respond to one of the comments that we got on the last video when we were talking about variable versus fixed rate mortgages. The poster asked what happens when my payment didn't increase when the interest rates increased. They went to the bank and they were given the advice not to increase. Let's talk a little bit about what happens when interest rates go up. So basically what we've got here is the blue line is a timeline of a mortgage. And a typical mortgage in Canada is about 25 years long with an amortization. So what happens is you're making your payments all the way along. You've got your principal and interest payments and you're set that you're going to have zero balance at the end of 25 years. When interest rates increase, they've gone up. What that means, if you're with a variable rate mortgage where the payments don't change, then all that happens is your principal payments go down because the interest portion has increased because the interest rate has increased. There's a side effect or there's a disadvantage to that. What ends up happening is at the end of your 5-year term, you could actually have a negative amortization. So what do I mean by that? So let's say you've gone in here and you're coming up to your 5th year on your first renewal. Now what happens is when your interest rate increased, let's say because more payments were going to interest than principal, you now have a higher balance owing than you had planned on at this point in time. The problem is that when you buy a home, it's amortized over 25 years. So written into that contract, there's going to be a clause that says you still have to have the mortgage paid off in 25 years. So what happens? On your renewal date, when you're renewing your mortgage, your payment is going to be higher than it needs to be. Okay? So what happens is if you just continue on track, like let's say right now, because you've got a higher balance, now instead of being on track for 20 years, instead what's going to happen is maybe you're going to have 23 years left on your mortgage. So you've paid for 5 years, but you have 23 years left. And the reason for that is you've been paying less towards principal. The best thing that you can do, if you're on a variable rate mortgage that does not increase when interest rates increase, you call up the bank and you tell them that you want to increase your payment by the amount that's required because of the interest rate increase. As you increase your payment each time, or that the interest rates increase, you're staying on track so that you'll still have it paid off in 25 years and you're not going to have a huge jump on renewal. If you have that huge jump, that's called payment shock, and you don't want to have that. You want to be able to acclimate to the new payments as the interest rates are increasing.